Welcome back to the Deep Dive. It is Tuesday, January 2026. If you've been anywhere near a trading terminal or, a financial news feed this morning, you know exactly why we're here.
Oh, yeah.
We are turning our attention to the absolute center of the storm. Innodata, ticker symbol INOD.
It's the only ticker anyone is talking about today. You really can't scroll past it.
It really is everywhere. As we speak, the stock is hovering right around, $61.54?
Yep.
That puts the market cap at a cool $2 billion.
Yeah.
But if you just look at that price tag, you're missing, 90% of the story.
Easily.
This isn't just a stock moving up or down. This is a battleground. I feel like we're watching a gladiator match in the middle of Wall Street.
That's a pretty fair analogy. It's incredibly rare to see a single company get hit with such diametrically opposed news on the exact same morning.
Right.
Usually a company has a good week or a bad week. Innodata has somehow managed to have the best day and the worst day of its life, simultaneously.
It is wild. On the one side, you have the bulls absolutely popping champagne. Just hours ago, Innodata announced they've secured a prime spot on the Missile Defense Agency's SHIELD contract. Missile Defense Agency just sounds expensive and important. That looks like massive government validation for their AI.
It is the holy grail for a tech company. When you get Department of Defense money specifically for something like the SHIELD contract, that's a seal of approval you simply can't buy with marketing dollars.
Right.
It suggests their technology is robust enough for national security. And that is a huge moat, or at least it looks like one.
But then you have to look at the other side of the tape.
Yeah.
Literally today, the law firm Braunstein, Goritz, and Grossman announced a new investigation into corporate wrongdoing.
At the same time.
So in one hand, you have this prestigious government contract, and in the other, you have fraud allegations.
It's a perfect storm. And that's exactly why today's deep dive is so critical. We aren't here to trade the chart. We aren't here to guess where the stock goes in the next hour, or even by the closing bell. Our mission is to strip away the hype, both the euphoric positive hype of the contract and the, terrifying negative hype of the lawsuit. We're going to apply a strict Graham and Dodd value investing lens to this high-flying AI stock.
Right. We're going to look at this business the way Warren Buffett would if he were sitting at his desk in Omaha today sipping a cherry Coke. We're analyzing business ownership, not stock speculation.
And I'll give you a little sneak peek at where we might end up, just to set the stage. When you look at the financials, honestly, they get a solid A-. The numbers are impressive.
Okay.
But when you look at the valuation, that's looking more like a D. And the management score, well, that's where it gets really complicated.
So the big question we need to answer is this a value investment that happens to be growing fast, or is it just a venture capital bet disguised as a public stock?
That's the question.
Let's get into it. Part 1. Chapters 1 to 3. Business, Management, and Financials. Chapter 1. Business Understanding.
All right, let's unpack this.
Okay, let's unpack this company. So Innodata has been all over the headlines as a generative AI play. If you just read the press releases, you'd think they spun out of OpenAI or Google DeepMind a few years ago. But they aren't exactly a new startup from Silicon Valley, are they?
No, far from it. And this is crucial to understanding the DNA of the company. Innodata was founded in 1988.
88. Wow.
That is over 30 years ago. To put that in perspective, they were in business before the World Wide Web was even publicly available.
So what were they doing back then?
Back then, their business was manual data entry and digitization.
So we're talking about like warehouses full of people typing.
Essentially, yes. Think about taking stacks of old books, legal documents, or medical records and having humans literally type them out to create digital files. They were a digital filing cabinet service.
So for decades, they were this legacy service business. But today, they market themselves as the engine room for generative AI. How does a company pivot from typing out old books to powering the most advanced technology on Earth? That seems like a massive leap.
It is a fascinating evolution, but it's actually a pretty logical one. To understand it, you have to understand a concept called RLHF.
RLHF?
Exactly. It stands for Reinforcement Learning from Human Feedback.
Okay, let's break that down. We hear that acronym thrown around constantly in tech circles. What does it actually mean in practice?
Well, think of a large language model like GPT-5 as a brilliant but completely unguided student. It has read the entire internet.
Right.
It knows every fact in Wikipedia, every Reddit comment, every legal case file. but it doesn't inherently understand nuance or safety or professional tone. It can't distinguish between a well-reasoned medical diagnosis and, a conspiracy theory it found on some forum.
Right. If you train an AI purely on the raw internet, you're going to get a very chaotic and probably toxic personality.
Right. Exactly. It needs a filter. It needs teachers. These models need humans to intervene and say, this answer is accurate and safe, or this answer is a hallucination, or this answer is legally dangerous.
So that grading process.
That process of humans grading and correcting the AI's homework, that is RLHF, and that is what Innodata does.
But we aren't talking about just anyone doing this grading, right? This isn't random people on the internet clicking buttons for pennies.
No, and that is Innodata's specific pitch. They provide humans in the loop, but they focus on high-stakes fields. Think law, medicine, finance.
Boy.
They're hiring PhDs, lawyers, and doctors to validate this data. If you are training an AI to help surgeons during a procedure, you can't have a college student validating the data.
No way.
You need a board-certified doctor to say, yes, that anatomical reference is correct.
So that brings us to the big question of the moat. In value investing, we always look for a durable competitive advantage. The bull argument here must be that Innodata has a franchise.
That's the bull case, yeah.
They have deep domain expertise, like their Synodex division for medical data or agility for PR.
The bulls would argue that while basic data labeling like identifying stop signs for self-driving cars, that's a commodity that anyone can do.
Right.
But what Innodata does is a craft. It's bespoke. They'd argue that having a network of thousands of these subject matter experts and a proprietary platform to manage them creates a barrier to entry. It's hard to just, replicate a network of doctors who are willing to train AI.
That makes sense. But I know you have a skeptic's eye. What is the counter argument? What would a strict Benjamin Graham or Warren Buffett disciple ask here?
Well, a value investor would look at this and ask a fundamental question. Is this a software business or is it a labor arbitrage service business? Because the economics are very, very different.
What do you mean by that distinction?
Well, look at the scalability. In a pure software business, think Microsoft or Adobe. If you sell one copy of your program, the cost to sell the next million copies is almost zero. You write the code once, you sell it infinite times. Your margins explode as you grow. We call that operating leverage.
Pure profit flow through.
But for Innodata, their model appears to be linear. To double their revenue, they generally have to double their headcount of expensive experts.
Okay.
If you need twice as much medical data verified, you need to pay twice as many doctors. You can't just press copy-paste on a doctor.
That's a great point. You don't get that infinite leverage you see in a SaaS company. Your costs grow right alongside your revenue.
Precisely. And then there's the question of switching costs. If you're a massive tech giant like Google or Meta, and remember, Innodata serves 5 of the Magnificent 7, you have nearly infinite resources.
Mm-hmm.
If they find a cheaper way to get PhD feedback, or if they decide to build that team in-house, can they switch?
It seems like they could. I mean, they have the money to just hire their own doctors.
The switching costs are low to medium. It's not like ripping out your entire operating system or changing your cloud provider. It's just changing a vendor.
So let's apply the commodity check. Does the customer care who does the labeling?
They do, to an extent. Accuracy is the currency here. If Innodata can prove their data leads to a model that's 99% accurate versus a competitor at 95%, they win.
Right.
In high-stakes fields like law or medicine, that 4% gap is liability. And to be fair, their recent margin expansion suggests they are seeing some efficiency. They aren't pricing this like a pure commodity.
So there's some hope for pricing power.
Some. But the jury is still out on whether this is a durable moat that lasts 10 years or just a temporary advantage because they happen to have the experts on speed dial right now.
That distinction between a temporary lead and a durable moat is everything in value investing. You don't want to pay for a moat that's going to dry up in 2 years.
Never.
Let's move on to the people running the show. Chapter 2, Management Evaluation.
All right, the jockeys.
We've looked at the business model. Now let's talk about the jockey. The CEO is Jack Obohoff, and he's been at the helm since the 1990s. That is a lifetime in the tech world. Most tech CEOs last 5, maybe 10 years.
It really is an eternity. And in many ways, that's a positive. He's a survivor. Think about what he's seen. He navigated the dot-com bust in 2000.
Right.
He steered the company through the global financial crisis in 2008. And perhaps most impressively, he managed the slow death of the print publishing industry, which was their original bread and
It's a
butter.
huge challenge.
Huge. And he successfully pivoted the ship to AI when many other legacy data companies simply went extinct. You have to give credit for that resilience and adaptability.
What about capital allocation? How are they treating shareholder money? Are they lighting it on fire, or are they being prudent?
It's a bit of a mixed bag, but I'd say it's leaning towards prudent. As of the third quarter of 2025, they're sitting on about $74 million in cash.
Okay.
And they say they're investing this in pre-training data and expanding their federal footprint, which clearly aligns with the missile defense news we saw today. They're putting the money where the growth is.
Any buybacks?
Very negligible history. A small repurchase back in 2019, but nothing significant recently. They aren't returning cash to shareholders, they're reinvesting it.
And what about insider activity? We always like to see management eating their own cooking. If the CEO believes the stock is going to the moon, he should be buying, not selling.
Yeah, and this is where it gets a little concerning for a value investor. Jack Abelhoff sold about 8,000 shares in December 2025 at around $53 per share.
Mm.
Now, look, executives sell for tax reasons or estate planning all the time. It happens.
Sure.
But Buffett prefers managers who buy, or at the very least hold, when they believe the company is significantly undervalued. Selling into a rally right before these big catalyst events like the MDA contract, it just sends a mixed signal. It doesn't scream maximum confidence.
But there's a bigger red flag here regarding management, isn't there? We have to talk about the candor test.
This is the most critical part of the management evaluation. In February 2024, Wolfpack Research issued a short report alleging AI washing.
I remember this.
They basically claimed Innodata was misrepresenting their tech, that it was more manual labor in offshore centers than the AI magic they were selling.
And look, short reports happen. Short sellers are incentivized to drive the price down. But it's how management handled the fallout that matters to us.
Correct. The critical failure here isn't necessarily the allegation itself. Companies get accused of things all the time. The failure is the disclosure timeline regarding the government's response.
Okay.
The company received a subpoena from the Department of Justice in August 2024. August. But they didn't disclose this to investors until months later in November.
That is a long time to sit on a DOJ subpoena. That's an entire fiscal quarter.
It's an eternity in the markets. And in the value investing rulebook, integrity is binary. You either have it or you don't. Delaying the disclosure of a federal investigation is what we call a management risk. It suggests a lack of transparency.
It sounds like the kind of thing that would scare off a conservative investor like Buffett immediately. He always says, you can't make a good deal with a bad person. Right? Not to say they're bad people, but that lack of candor is a strike against the trust account.
It creates a trust deficit. When they announce good news like this huge contract today, you want to believe it 100%. You want to cheer, but that shadow of the delayed disclosure lingers in the back of your mind.
Yeah.
You wonder, is there something else they aren't telling me?
Exactly. Trust is hard to gain and easy to lose. But let's move to the numbers. Because despite the trust issues, the financial performance has been, well, undeniable. Chapter 3. Financial health.
This is where the story gets good again.
This is arguably the strongest part of the bull case. If you ignore the noise and just look at the spreadsheet, this company looks like it has started firing on all cylinders.
The turnaround is objectively impressive. You really cannot argue with the growth trajectory. If you look at revenue, in 2023, they did about $86.8 million.
Okay, $86 million. Solid, but sleepy.
Then look at 2024. That jumped to $170.5 million.
Ooh.
That is 96% growth year over year. They basically doubled the size of the business in 12 months.
Doubling revenue in a year is rare for a startup. For a 30-year-old company, it's practically unheard of.
Extremely rare. And it continued into 2025. In the first 9 months alone, they hit $179 million, up another 61%.
So it wasn't a fluke.
No, the guidance implies this 45% plus growth is continuing. This isn't a blip, it's a trend.
And it's not just empty calories, right? Sometimes companies grow by selling dollar bills for 90 cents. They lose money on every sale just to show revenue growth.
That is the inflection point here. From 2021 to 2023, Innodata was consistently losing money. They were burning cash to build this infrastructure. But in 2024, they swung to a net income of $28.7 million. For the first 9 months of 2025, they're already at $23 million in profit.
So they cross the chasm from money losing to profitable. That is a massive de-risking event. What about margins? You mentioned earlier that margins would tell us if they have pricing power.
Right, and gross margins have expanded to around 41%. This is a very important data point.
How so?
It counters that commodity argument we discussed in Chapter 1. If they were just a digital sweatshop doing basic data entry, you'd expect razor-thin margins, maybe 15 or 20%, because competitors would just undercut them.
Sure.
41% suggests they're adding real value that customers are willing to pay a premium for.
And the balance sheet.
Clean as a whistle, cash-rich, debt-free. As we noted, $74 million in the bank. This passes the safety test.
Wow.
It provides a buffer for legal fees, which, given the news today regarding the new investigations, they might unfortunately need.
That's a good point.
Yeah.
So purely on financials, they are looking strong. A value investor would look at that income statement and smile. But now we have to translate that performance into stock price.
Yeah.
And that is where things get tricky.
Very tricky.
Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion. Chapter 4, market sentiment.
Okay, the fun part.
We've established that the business is growing fast and making money. But the stock price, wow, it's up 67% in a year. The AI sector is absolutely foaming at the mouth right now.
This is where we have to separate the business performance from the stock performance. The greed factor is in full effect. The market isn't just pricing in the current success, it's pricing in a fantasy future.
And it's not just retail investors chasing a ticker. We saw a major analyst move recently that poured gasoline on the fire.
Right. On January 5th, BWS Financial upgraded IND to a top pick and slapped a $110 price target on it.
$110. That's nearly double where we are today.
That kind of target just lights a fire under the retail momentum algorithms. It creates a fear of missing out or FOMO frenzy.
Of course.
People see 110 and think they're getting a discount at 60. But as value investors, we have to look at the valuation reality. We need to do the math.
So let's do the math. What are we actually paying for this earnings stream?
The current price-to-earnings ratio, or PE, is around 60 times. 60. 60 times earnings. That is steep.
It is high, but let's look at it through the lens of earnings yield, which is just the inverse of the PE. It tells you what percentage return the company is generating on the price you pay.
Okay.
If you buy the whole company today for $2 billion, your yield, based on current earnings, is about 1.6%.
1.6%, that's not a lot.
Now compare that to the risk-free rate. You can go out today and buy a 10-year treasury bond that pays you 4.28%.
So let me get this straight. I can take zero risk, literally guaranteed by the U.S. government, and get over 4%.
Oh.
Or I can take massive risk on a volatile AI stock with legal issues and get a 1.6% yield. Why would anyone take that deal?
The only answer is growth. You are betting that the 1.6% yield won't stay 1.6%. You are betting that earnings will explode.
This is the growth at a reasonable price argument. You pay up now for future cash flows. Exactly. But let's run the numbers to see what the market is implying. To justify a $2 billion market cap today, relative to those risk-free rates, Innodata needs to grow earnings at roughly 30% annually for the next 5 years straight.
30% a year, every single year, for 5 years. No stumbles, no recession, no lost contracts.
That is a very high bar. It assumes a blue sky scenario where the legal risks just vanish, the competition doesn't catch up, and the contracts keep flowing.
The market is pricing in perfection.
Total perfection.
And that brings us to the tug of war we are seeing today. You have this valuation that demands perfection, and you have these violent clashes of news.
Yeah.
It's a battle between government validation, the MDA contract, and fraud allegations, the lawsuits. Sentiment is literally being pulled in two directions simultaneously. The bulls are reading the contract award and ignoring the lawsuit. The bears are reading the lawsuit and ignoring the contract.
It's not just sentiment, it's also about who actually owns the shares, because the ownership structure determines how volatile this thing is going to get.
Big time. Let's look at the cap table. Chapter 5. Ownership structure.
Who owns this thing?
Who is actually holding the bag here? Is it mom-and-pop investors, day traders, or the big whales?
It's a mix, but the institutional presence is heavy. About 58% of the float is owned by institutions.
Yeah.
So you have the big passive players like BlackRock and Vanguard. They're there because they have to be. It's part of the indices. When you buy a total market index fund, you are buying a tiny slice of Innodata.
But there's another group we need to talk about. The short sellers. These are the people betting the stock will crash.
And this is critical for understanding the volatility we are seeing today. The short interest is significant, around 15% of the float.
15% is high. That means 15% of the available shares have been sold by people betting the price will go down.
Exactly. And this creates a really polarized stock.
A binary bet, basically.
A binary bet, exactly. You've got, 15% of the money thinking the company is a zero or a fraud. The aggressive growth funds think it's a double or a triple. There is no middle ground here.
And when you have news like the Missile Defense Agency award dropping today...
That is a nightmare for the shorts.
Yeah.
Imagine you're short the stock, betting on the fraud allegations, and suddenly the Department of Defense writes the company a check. The stock jumps. You start losing money rapidly.
And you panic.
You might be forced to buy the stock back to close your position just to stop the bleeding. When you buy, you drive the price up even further. That forces other shorts to buy.
That's the classic short squeeze.
Precisely. So the move we're seeing today, this volatility, it might not just be about the fundamentals of the contract. It could be technical mechanics, shorts, running for the exits, tripping over each other to buy back shares.
Which makes it a dangerous place for a conservative investor to step in. You don't want to be buying just because shorts are covering.
Yeah.
Market plumbing, not value creation.
Correct. It creates these violent upside moves that are completely unrelated to the long-term value of the business.
Speaking of danger, let's go to the section Buffett would probably spend the most time on. Chapter 6. Risk assessment.
Rule number 1.
Rule number 1, never lose money. Rule number 2, don't forget rule number 1. This is the anti-Buffett section where we look at everything that could go wrong. And today, the list feels pretty long.
The list is substantial. We have to start with customer concentration. We call this the one buyer problem.
We mentioned they serve 5 of the Magnificent 7. That sounds like a brag. We work with Google, Apple, Meta. But you're saying it's a liability.
It's a double-edged sword. Yes, it validates their quality. It proves they can handle scale. But it means their revenue is highly concentrated in a few massive decision makers.
Right.
If Google or Meta decides tomorrow that they want to bring this capability in-house, what we call vertical integration, Innodata's revenue could collapse overnight.
And these big tech companies have the cash to do it. They aren't helpless. They have more cash than most countries.
They are the most resource-rich entities in human history. Betting that they will need Innodata forever is a risky bet. It's like being a supplier to Walmart. Great volume, but they own you.
Then we have the elephant in the room. The legal overhang, we call it the black cloud.
We can't ignore it. Let's just recap the facts. Wolfpack Research accused them of misrepresentation in February 2024. Then came the DOJ and SEC subpoenas later that year. And now, today, January 20, 2026, we have this new announcement from Braunstein, Gurwitz, and Grossman regarding corporate wrongdoing.
So the fire is clearly not out. It's not just one report. It's a sequence of events.
No, it's smoldering. And here's the risk. Even if Innodata is completely innocent, even if this is all just noise and ambulance-chasing lawyers, legal defense is expensive.
Very.
It is a tax on shareholder capital. Every dollar spent on high-priced corporate defense attorneys is a dollar not spent on AI development or marketing.
And if they aren't innocent,
then it is a permanent capital loss event. A fraud finding or a massive regulatory fine changes the thesis instantly. The stock could go to single digits. We've seen it happen before with other high flyers.
that is a terrifying thought for anyone buying at $60. Is there a technological risk too?
Yes, the risk of AI washing or, obsolescence, we have to ask. Are they truly AI-enabled, or are they just a digital sweatshop?
Yeah.
If they're just providing labor, competitors like Scale AI or Labelbox will eventually drive prices down. It becomes a race to the bottom. We call this the commodity trap. If you don't have unique IP, your margins eventually get crushed.
And if the AI gets good enough to grade itself, do they need the humans anymore? But let's save that existential crisis for the end. It's time to give out the grades. Chapter 7. Conclusion.
The final report card.
We've looked at the business, the management, the numbers, the market, and the risks. Let's pull it all together into a final report card. How does Innodata stack up?
Let's go through it category by category. First, the business. I give it a B-.
B-.
It's a necessary service right now, clearly. The world needs RLHF. But the moat is debatable. It's heavy on labor, and the scalability isn't quite what you want in a tech stock.
Management.
That's a C. You have to respect the turnaround execution Jack Abuhoff has delivered on growth. You can't take that away from him. But the candor issues, Specifically, the DOJ delay and the insider selling are major red flags. A value investor needs to trust the people writing the checks, and that trust is shaken.
Financials.
A minus.
Ah,
This is the bright spot. Exploding revenue growth, a clean balance sheet with lots of cash, and they are profitable. You can't argue with the spreadsheet. If the legal issues weren't there, this would be an A+.
and finally, valuation.
That's a D. At 60 times earnings, there is zero margin of safety. You are paying top dollar for growth that hasn't happened yet. You are paying for the blue sky scenario.
So what is the final verdict?
Innodata is a fascinating speculation,
Okay.
but it is not a value investment.
That is a key distinction.
It is. If you're buying today at over $60 a share, you are betting that the growth will outrun the lawyers. You are betting that the missile defense contract is just the tip of the iceberg and that the DOJ investigation will just disappear.
You aren't acting like Warren Buffett.
No, you are acting like a venture capitalist. You're taking a high-risk bet on a potential moonshot. And look, sometimes those bets pay off. The MDA contract is a huge win, but the legal clouds mean the risk of permanent loss is non-zero.
So if you are in it, know what game you're playing.
Exactly. Don't call it safety, call it a wager on the future of AI labor.
And that brings us to our final thought for the day. We've talked a lot about Innodata's business of humans teaching AI. It's a booming business right now. It is essential.
It is, but it raises a profound question about the future.
Right. If the whole goal is to train the AI to be smarter, safer, and more accurate, at what point does the student surpass the teacher? If Innodata does its job perfectly and the AI learns everything the PhDs know, does Innodata work itself out of a job?
It's the ultimate irony. They might be building the very thing that makes them obsolete. If the AI becomes self-correcting, the human in the loop becomes a bottleneck, not an asset.
Something to think about while you watch the ticker tape today.
Indeed.
That's it for this deep dive.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.
We'll see you next time.